a number of things to discuss. Because you talk about where we are, whether it's a bear market or not. Jim Lebenthal, you don't want to admit that it's a bear market because what you told our producing team today is that you're still convinced it's a correction and not a bear market. And as you heard Josh just describe, and the numbers don't lie, it is, in fact, a bear market. It's a matter of how long it's going to last, right? It's a matter of price and a matter of time. And maybe we haven't gone through enough time, even though the price has obviously been ugly.
So there's a few things to consider here. It's a bear market in the NASDAQ. The numbers don't lie there. The NASDAQ, however, as I've said for quite some time, is not the market overall. It's a sector fund. 2/3 of it is communications and telecommunications and technology. It's not the broad market overall. That's what the S&P 500 is. Now, I will tell you we're close to the technical definition of a bear market, but we're not there yet, which is down 20% on the S&P 500. We're just not there yet. On the other hand, there is more than the technical definition of a bear market. Bear markets last a very long time. If you think just about the great financial crisis, went down over 50%, took 5.5 years to recover. Tech telecom bust went down almost 50%, took 7 years to recover. A correction, which is, yes, what I believe we're in right now, is much different. A correction is over and done with in a year. Take a look at 2015 to 2016. That correction peak to trough was 9 months. You recovered in 5 months. And in the entire year of 2016 was a very positive year. Frankly, that's where I think we are now. But here's the important point. When you're at the bottom in a correction, it feels terrible, and it feels like it's going to be a heck of a lot worse. In part, that's because of a lot of false bottoms. The 2015-2016 correction had 4 bottoms before the final bottom was put in. We're on our 4th bottom in this potential correction. Only time will tell if it's a correction or a bear market. The fundamentals have to support it. Now, on that, I will say this. This is a market, and this is a call, correction versus bear market, that teeters on the fulcrum of what inflation does. And I hate looking at tomorrow's CPI report as the Super Bowl of economic statistics, but frankly, it's very, very important. I am a long-term investor, but for the short-term call, whether we're in a correction, whether it's going to get something worse, that CPI tomorrow is very, very important. If it comes in below 8%, I'm going to feel a lot better on the headline year over year. That's what I'm looking for.
Okay. So, Steph, I turn to you. And Fundstrat's Mark Newton has a note today. He says it's still too early to call a technical bottom. Bottom line, it's early to expect a meaningful low, he says. A defensive stance remains prudent. One should be heavily diversified and not overly concentrated, particularly in sectors like technology, which are under tremendous pressure. Opportunities to buy dips should materialize over the next 1 to 2 months. That suggests that there's more time to go, and as such, probably more downside, at least in price. According to this gentleman here, he points to stocks like Microsoft, big important stocks that have broken support. 270 was the line in the sand for him. Josh has talked about a number 270, 275 for Microsoft as well. If you take a look at the mega cap wreck, as we're calling it, we'll show you a wall of what we're speaking about. Over the last 3 sessions alone, there are stocks like Apple, which has given back $220 billion in market cap. There's Microsoft at near 190, Amazon 173, Tesla 199, Alphabet 123, Nvidia 85, Meta 70, for a total of $1 trillion in market cap lost simply over the last 3 sessions.